Is Supermicro a buy or a sell? Let's get started with the model. This is a large cap company, 15 billion market cap. They're trading at $26 a share, and they have 586 million shares outstanding. Supermicro develops and manufactures high-performance server and storage solutions based on modular and open architecture. Its products include servers, storage systems, modular blade servers, blades, workstations, full racks, networking devices, server subsystems, server management software, and security software. Just yesterday, on October 31st, the accounting firm Ernst & Young fired Supermicro. This is the first time in history an accounting firm refused to work with a publicly traded company. There appears to be lots of accounting manipulation and fraud going on at this company. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is all over the place. Positive 65 million, negative half a billion, back to positive again, positive 600 million, that's in 2023. For the trailing 12 months, they have a really big negative, negative 2.5 billion. Looks like a lot of manipulation to me. Net income is the profit or loss on the income statement. It's revenue minus expenses. That looks really good, from 100 million up 150% to 280 million, up 120% to 600 million, then up 90% to 1.2 billion in the trailing 12 months. Margins aren't so great. 8% net profit margin. That means they convert 8% of their revenue into net income. Revenue is a sales for the company. That looks amazing. 3.6 billion, close to 15 billion. But is it legit revenue? Now we all question their numbers. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 25 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $19 billion. We divide that by 586 million shares. And we get a calculated stock price of $33. They're trading at $26, so they're trading at a 21% discount. It's a buy according to the model. I'm using the future free cash flows based off of analyst expectations. But to compensate, I gave them a really high whack, 15%. The whack should be like 8 or 9%. Say it was a normal whack, 8%. Then the stock is $82. But with all this bad press going on, I gave them a high whack because I don't really trust the stock anymore. There are 41 companies in the same industry as SMCI, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't really spend much in CapEx, which is surprising, only 37 million. Dell spends the most, 2.7 billion. It's not even close. HP is the second biggest at 570 million. Arista is only 30 million. They have a good debt to equity ratio, 0.4. That's equal to the average. For every dollar of equity, 40 cents of debt. Most companies do not pay a dividend in this industry, including them. They have the worst free cash flow, negative 2.5 billion. We should look at that statement of cash flows. I wonder why it's so bad. They rank 7th in market cap at 18 billion. Arista is number 1, then Dell. Dell was number 1 for so long, now they're number 2. Price to book is 3.5, that's stock price of a book value per share. PE is pretty good at 17. Better than the median average. PE is stock price of earnings per share. We can't look at their price to free cash flow. They have negative free cash flow. Price to book is 1.5, so they're trading at 1.5 times revenue. And for some reason, the website I pulled the data from does not list their 5-year annual revenue growth rate. Nano Dimension is 55%. They're the biggest. Arista is 22%. I guess that's why they're number 1. Dell is 0. They're flatlining. They're not even growing anymore. This stock was super hot. It was up more than Nvidia at one point in terms of percentage growth. One share was getting close to $1,000, so they did a 10-for-1 stock split exactly a month ago. If you put $10,000 into this company 10 years ago, at one point that $10,000 would have been like $330,000. Even with the big decline, that $10,000 is $89,000. A great return, a 24% annual return. But I have a feeling it's going to go down a lot more. So to summarize, I have them trading at a 21% discount, ranking 3 out of 10. Too many red flags with this company lately. More red flags than at a Matador convention. Would I buy at 1 out of 10? I would stay far away from this company. Ratio is 5 out of 10. They look about average. Financials are 8 out of 10 because their revenue has grown 320% since 2021, which is pretty amazing growth. The last time this company reported earnings was in August. They were supposed to report this week, but as you know, their accounting firm quit, so now they're in a mad scramble to find another one. Let's go through their results from the last quarter, then we'll talk more about the fraud. The last earnings was their fourth quarter of 2024, $5.3 billion of revenue, up 38% quarter over quarter, up 140% year over year. Margins 11.3%, which is down, so that means their expenses are getting higher. EPS 6.25, operating cash flow negative $600 million. So even though revenue is high, they're still burning a lot of cash. 95% of their revenue is server and storage systems, 5% subsystems and accessories. Both up a lot quarter over quarter and year over year. Here's their quarterly revenue last 5 quarters. $5.3 billion, which is a big jump from the prior quarters, which is right in the middle of their guidance. Their guidance was $5.1 to $5.5 billion. Almost exactly in the middle. Definitely some fraudulent activities going on. Cooking the books. Here's their revenue by geography. 61% USA, 10% Europe, 24% Asia, and 5% other. And China is less than 1% of their revenue. Their margins are getting worse, their gross margins. If they're cooking their books, they should cook it a little better. It went from 17% down to 11%. Gross profit margin is gross profit over revenue. It's a percent of your revenue you convert to gross profit. So this implies that cost of revenue is getting higher. Operating expenses are getting higher. It's up to $180 million. Operating margins 7.8%, a big drop from prior quarters. And they say the reason for higher operating expenses is the investments in talent and R&D. EPS is 6.25, which is down from the prior quarter, and they fell short of guidance. Guidance was 762 to 842. They're burning a lot of cash. Their cash flow is negative in 4 of the last 5 quarters. Negative $600 million in this quarter. Last quarter, negative $1.5 billion. Before that, negative $600 million. But in the first quarter of 2024, they did have positive cash flow. Net cash is cash minus debt, so they have a big shortfall. Their debt is $500 million more than our cash. It's right here. Total cash, $1.7 billion. Total debt, $2.2 billion, which gives you negative $500 million. And they show you the cash conversion cycle. That's inventory days plus AR days minus AP days. The cash conversion cycle tells you the number of days it takes for a company to buy inventory and convert that inventory into cash. Because first you buy the inventory and then you have to do something with it. You might have to manufacture it, you might have to combine it with other things, and then you eventually have to sell it. But you might extend credit, so you have to wait for the customer to pay you. And if you buy some inventory on credit, you minus the accounts payable, the number of days it takes you to pay. If they released earnings on time, meaning if they released it this week, the guidance was $6 to $7 billion. Full year revenue guidance, $26 to $30 billion. Here's a letter on the company's website, and this letter is from 2 months ago, September 3rd. They mentioned the delays in filing their quarterly returns. They also reference a short seller, that's Hindenburg, but they don't say their name. And they have to do spin control, so they say neither of these events affects our products or ability to provide services. We remain well positioned to deliver our broad product portfolio to you and our thousands of customers. Our audit committee decided to delay the filing of our annual report. We formed a committee to review our internal controls and other matters. I continue to have strong confidence in our finance and internal teams. We more than doubled revenue year over year. It's easy to double when you fudge the numbers, which is more than 3 times the industry average. We also heard of a report from a short seller hedge fund that contains false or inaccurate statements about our company, including misleading presentations of information that we have previously shared publicly. As you know, short sellers are designed to drive the stock down. But this is the only thing they mention on their website. There's nothing more recent. I thought they would release information today talking about the resignation of Ernst & Young. The stock is down 45% this week, wiping out all gains for the year. I'm making this video on Friday the 1st. The stock dropped 10% today. The stock declined the most on Wednesday after the company said it had lost its second auditor in 2 years. How do you lose 2 auditors in 2 years? It looks like Supermicro will talk about this next Tuesday. That'll be Tuesday the 5th. The stock price closed today at $26. Its peak was almost $119. So the stock is down around 80% in 8 months. I wonder if this is going to bring Nvidia stock down. It could be. Their market cap went down $55 billion. So that's $55 billion of value investors lost. If you're watching this video, I hope you're not one of them. It all started 3 months ago in August when the company said it would not file its annual report on time. That is a big red flag. I wish I shorted it then, but hindsight's 2020. And then Hindenburg announced their short position in the company, talking about accounting manipulation. Ernst & Young was their accountant for 17 months, and they're unwilling to be associated with this company anymore. Of course, Supermicro disagrees with E&Y's decision to resign. It's really common for a company to fire their CPA, but it doesn't make sense when it's the other way around. Now Supermicro is getting downgraded by the analysts. It's going to be really hard for this company because a spotlight is on them. If they were doing anything wrong, they have to fix that. They have to correct it because too many eyes are watching them now. When they were late in filing their financials, the NASDAQ sent them a letter. And that letter said they were not in compliance with the exchange's rules. Because when you're a publicly traded company, you have to file your financials on a certain schedule, on time. That's why some companies don't want to become public, because there's too much scrutiny, there's too many rules. They can never be late in filing. So this company has not filed financials with the SEC since May. They did release financials in August, we just went through those. Anyone can provide financials. You can just write numbers on a page. But when you provide it to SEC, it has to be totally accurate. Everything has to be in the right order. Because if you try to fudge things, you get in a lot of trouble, maybe even jail time. Here's another article for today. Why did the stock fall again? Investors continue to bail on Supermicro. A highly unusual situation after a short seller attack and delay in its 10K filing. Here's their stock chart the past year. It peaked in March at around 115. I think it was 117. And it's been going down and down and down. Then it fell off a cliff this week, down even further. So if you bought it at the end of last year, you're flat now. But I feel really bad for all the people who bought it north of 80. They're down a lot, and they're not getting that money back. Enron Part 2. They are scheduled to release earnings next Tuesday. I don't know how they're going to do it so fast, especially without a CPA firm. I'm really excited for next Tuesday. I hope you are too. If you want to learn how to really dig into financial statements, click on the video in the top right corner. Thanks for watching.